So that music's not about me, although I was in the movie. I'm the old guy with the crusty voice who works in the dungy gym who is training Rocky. The reason I played that song is I think it symbolizes anything is possible no matter how bad the odds are. And if you're a hedge fund manager, despite what we heard 2 weeks ago from a very large public fund and why they're leaving the hedge fund industry, because most hedge fund managers have houses in the Hamptons and also private jets. The reality is most hedge funds are struggling. In a recent survey by Pequin, it showed that 60% of hedge funds have less than 100 million in assets, but only 5% of assets were flowing to hedge fund managers with less than 100 million in assets. And if you do the statistics for plans below 500 million, it's not much better. When you do the math, 60% of 15,000 funds means that the business is very, very competitive. And as we've heard multiple times before, investors are looking for a reason to exclude a manager. They use a funnel approach. They're getting contacted by thousands a year. They are doing meetings with a couple hundred, and they're allocating to 2. So the reality is most hedge fund managers that are emerging will never be $1 billion hedge fund. It's just a very, very competitive business. But there is hope. Like Rocky, with the right focus, with the right strategy, with the right determination, you can be successful. You can be successful if you have 3 things. You must have the highest quality product, you must have the highest quality marketing message, and you must have the highest quality distribution. And if your assets that are coming into your firm are not what you want them to be, it means that in one of those 3 areas, you need improvement. And sometimes it can be just a slight improvement in one of those 3 areas that's the difference between slow growth and exponential growth. And what I'd like to do is kind of talk about each of those 3. And I think sales is a process. And I do think that if you have strengths in all these 3, I think you're almost guaranteed to raise money. So let me talk about the first. The first is quality of product. You know, one problem a lot of hedge fund managers have is they don't really know how to evaluate themselves. You know, they don't completely understand what the evaluation factors investors use to select hedge funds. And as a number of people have said today, you know, performance is a lot more important than most people think. You know, performance tends to be a screen that you have to, rank above, let's say, the top 10% of hedge funds. And if you fall through that, then all the other factors people look at are equally important. The problem is if you're in the top 10% of hedge funds, you rank in the top 1,500 hedge funds. The other reason a lot of hedge fund managers have difficulty evaluating their product is because I know there a couple people in the panel said, investors are getting a lot better at giving feedback. I mean, the answer is they aren't that good at giving feedback. It's very rare that an investor is going to say, you know what, I'm not investing in your fund because I think you are a complete moron, or I don't like your strategy. It's typically, I really like what I'm hearing, but try me back when you have 100 million in assets. I can't tell you how many hedge funds say, we're small now, but we've been told by a lot of people, when we have 100 million, we're going to go back and get an allocation. And I can tell you when you go back, they're going to come up with some other issues. They're just using that as a reason to kind of make you feel good and have you go on. So what are the factors people focus on? Well, the first is obviously the strength of your organization. And at a minimum, you have to be able to pass an operational due diligence exam. And if you're an emerging manager, you don't want the first exam you do to be with a really large investor that's going to potentially allocate your fund, because you're probably going to find something that's wrong, and when they do, they're never coming back. And then you're going to fix it, and you're going to go to them and say, hey, we fixed this, and it's too late. So you should try to have a mock operational due diligence exam, make sure you have that nailed down, and maybe go through a mock one every few years just to make sure you're very fine-tuned for it. But organization means a lot of other things too. Some things you probably don't even think about. For example, it's a lot easier to get people to come to your office if you're in Midtown than you're downtown. It's a lot easier to get people to come to your office if you're downtown than in the suburbs. And it's a heck of a lot easier to get people in your office if you're in the New York area than you're in some other city. That's just a fact. Another thing that's important is kind of, what do people see when they come to your office? I do due diligence on a lot of hedge funds. If you're in Midtown, you have an office that looks state-of-the-art, beautiful furniture, you got a wonderful conference room, flat screens everywhere. People can go in your conference room and you can show them your proprietary analytics up in your flat screen. People get an image of your firm based on that. It's a very good way to start a meeting. If you're in a Class B meeting, there's a dingy hall on the floor that they have to walk down to find your office. They go in and your furniture is used and scratched up. There's scratches on the wall. You have a conference room that doesn't look very good. And I guarantee you, I am explaining the situation for a number of people in this room. They're going to have a different impression of that. And the other factors that you have are going to have to be stronger to offset that. A lot of hedge fund managers that get to be $1.5 billion invest the money up front. They don't wait until the revenue comes and then invest in their company, because often the revenue doesn't come. Investment team is very important. And hedge fund managers are very good talking about their own background. But what I think they tend to lack is talking about the team. The strength and depth of your investment team is a way to differentiate your firm. And when you hire someone, it's very important you're hiring someone with very good talent. It's also important you don't have a lot of turnover. Turnover is a negative. So you can enhance, and again, it just takes a little bit to be the difference between getting an account and being a firm they think is pretty good, but you don't get the money. So, if you have a team, I think it's very important to bring out the strength of the team, have people meet the entire team, and get as much out of your team as you possibly can get. Investment philosophy and process. If people don't understand the inefficiency that you're going after and what your differential advantage is to getting that inefficiency, they're not going to invest. I can't tell you how many portfolio managers I've spoken to, and they're talking about how stupid analysts are. At fund of funds, at pension funds, they just don't get it. They don't understand. And what I tell them is, it's not their fault. They're the buyer. You have to be able to clearly articulate what you were saying so they don't understand it. And if they don't understand it, it's your fault, and you need to do something with your presentation. Risk controls and portfolio construction. You got to have a product that people want to buy. AMC used to make cars back in the 70s, and they thought the cars were absolutely fantastic, like the Gremlin. I mean, the people that designed it, they thought it was just great. The problem is no one bought it. There are a lot of portfolio managers who have very strong belief on how you should create a fund, and at times, it's just not what people want. And sometimes you can make very small tweaks to the portfolio construction and risk control, and you can get a product that you're getting very slow growth to get exponential growth. And I'll give you a couple examples. And I can give a lot of examples of this. I remember about 10 years ago, there was a manager that was a long-short equity manager, and they had 5% in private equity. And they believed in this crossover philosophy towards managing money. And the private equity portion of their portfolio added very little value. And they had a great track record, great organization, great bios, and they weren't raising money. And so I told them, listen, if you want to raise money, I understand this is in your soul that you want to do this. But if you really want to get to be a large manager, you got to get rid of this component of your portfolio. And having someone change what their deep philosophical belief is not easy, but they decided they wanted to do it. And once they did, it was very easy to sell this product. Another example, and this may apply to a lot of people in this room. It was a long-short equity manager that, again, had a lot of strengths, tremendous stock selection attribution on the long and short side. One problem they had is they had a very large drawdown. And the drawdown was unacceptable to investors. And so they were trying to go out and sell. Everything was good, but they had this drawdown. And I basically said, you're not going to sell this fund until you address this one issue. Investors do not want to experience that, and you need to convince them that you're never going to do that again. And the guys, telling me, well, our stock selection, and we buy cheap stocks. And I'm like, that is not going to work, You need to change your risk controls. And the reason he had this large drawdown is because he significantly changed his exposure, and he went really long, and he got annihilated. And I said, you just got to tell people you have a line in the sand, you're not going to go longer than 65%, and then people can mathematically calculate what you'd have done in this scenario. And after he changed his risk controls, he was able to effectively raise a lot of assets. And again, I can talk about a lot of different strategies, and I can point to examples of people where they made very slight changes to their risk control, and they significantly enhanced the marketability of their fund. Performance is important. You got to be above a certain level. But you also need to know, what you're selling. Are you selling absolute returns? Are you selling Sharpe ratio? Are you selling correlation? Are you selling how you do in down markets? And you have to understand what the market wants to buy. Back in 2007, we represented a market neutral fund, and it had a phenomenal Sharpe ratio. These guys were extremely talented. The problem is their annual return was only like 7.5%, and today you can sell that all day long. In 2007, you had to have a 10% return. And so what they did was they added a 2x version of it. And they went from like 200 million to 1.3 billion in 2 years. Just no change to people, no change to process, just simply, creating a product that the market wants. Service providers are important. We have some phenomenal sponsors to this conference. There's no excuse to have a prime broker that no one's ever heard of. It is a huge negative. Or an auditing firm that's no one's ever heard of. And then I would say fund terms. You don't want to be funky. You don't want to implement your philosophy on how the world should be with fund terms. You want to be kind of right in the middle of where all your competitors are. If you're an emerging fund, I think it's fine to offer a founder share, but I think discounting your fees if you're a mature fund, I just don't think it makes it much competitive. I think people are willing to pay for fees, as we've hired before, and I think there's a lot of hedge funds that if they gave their product away for free, no one would invest in it. So I think competing for fees is a mistake. The most important thing is first impressions only happen once, and what you don't want to do is travel all over the country, all over the world, telling everybody about your product, have no money coming in, and come back and realize, you know what, we need to change something. Because when you go back and try to see these same people, most won't see you, and the ones that do, if they have a negative opinion of you, it is very difficult to change a negative opinion into a positive opinion. I want to talk about marketing message next. So a lot of hedge funds will call me and want Agecroft to represent them. And typically what I hear is, hey Don, our product is fantastic, and it's the perfect time to invest in it. And our marketing message is strong. We got a 7-year record, and we've never sold the fund before, okay? So all we need to do is have someone sell our fund for us, and we're gonna raise a lot of money. And I can tell you, 90 to 95% of the time, they're wrong. They have been selling it, first of all. And there's probably an issue with their marketing presentation, or there's an issue with their products. I mean, I'm not going to give you examples. I'm just going to keep moving on. But if you want a strong presentation, the first thing you have to do is you have to be concise. If you're still in someone's office 60 minutes later, still describing your investment process, you're dead. You got to be able to describe your investment process within 30 minutes. The next thing you need to do is you need to be linear in describing your investment process. There are a lot of portfolio managers, I will sit down and hear what they're doing, and they're just all over the place. They're going on tangents, and they're talking about their organization and their team, and they're doing this, and I don't understand what the heck they're talking about. And what you got to remember is when you meet with someone, they are typically going to have to tell what they heard to someone else. It might be their partners, it might be their boss. So imagine you're taking notes and someone is just going off on all these different tangents and you're trying to write down what they're saying and then you have to repeat it to someone else. You know, if I was a junior analyst and I had to repeat it to my boss and someone was going all over the place, I wouldn't repeat it because I'd be embarrassed because I don't know what they do. So if you want to get up the line, you have to make it where they can take notes. It's very linear, where for each item, you are clearly articulating what the differential advantages of your firm are. You don't want to just talk. Everything you say should be differentiating you versus your competition. You also want to be consistent. You know, the first meeting of a hedge fund manager shouldn't be the portfolio manager. It should be the salesperson or someone else at the firm. And there is absolutely no excuse for a salesperson not to sound exactly like the portfolio manager. And, you know, what people should do is they should script out their presentation. And they should get everybody at the firm involved in creating the highest quality presentation you possibly can have. I mean, I used to be head of sales for the second largest hedge fund in the world. And we would all huddle and we would work together to figure out the best way of describing how we differentiate our firm for each of the evaluation factors people use to select a hedge fund. And everybody said the same thing. And why did we do that? Because I don't want anyone winging anything. You know, I want everything to be absolutely factual. And I want it to be the highest quality presentation we possibly can have. So that's why you script everything out, because, you know, when people come and see your firm, no matter who they meet with, you want them to hear the same answer. You know, a badly worded answer gets you eliminated. There's no excuse to have a badly worded answer. You know, I started doing this a long time ago when I used to head up institutional sales for Merrill. And I learned it traveling with these portfolio managers. I'd do 45 meetings in 2 weeks and they'd say the same thing over and over again. People would ask the same questions over and over again. And eventually I wrote it all down and I could present the product actually better than the portfolio manager after a while. You know, I was saying the presentations in my sleep. So I'm going to move on to the third point. You got a great product, you got a great marketing presentation, and now you got to tell people about it. And again, I would not go into the marketplace until you do both of those, because first impressions only happen once. You know, there's interesting things about selling hedge funds. The first is how small of a community it is. You know, investors share information. And if an investor hears about your fund from 2 other people unrelated to your firm, he is much more likely to invest in your fund than if all he does is hear about it from you. So that requires a lot of penetration in the marketplace. You know, if you really want to be a $1.5 billion fund, and right now you're 200 million or 300 or 50, you really need more than one person penetrating the marketplace in order to get that deep and create a buzz. Money is going to hedge funds with the strongest brands, not the best track record. And to get that brand requires a lot of meetings. You also need to get momentum of asset growth. There's this discussion in the hedge fund industry about this magical number that when you get to 100 million, it's going to be a lot easier to sell your fund. And I can tell you the difference between selling a fund with 90 million and 110 million, I don't think there is a difference. I haven't noticed it. 150 million, 90, I haven't noticed it. You know, 100 million is not a magical number. But what I can tell you is that every month, investors get your monthly statement. They look at your performance, and obviously you got to keep numbers up. If your numbers don't go up, they're not going to invest with you. But another thing that's just as important is what is happening to your assets. And if your assets are not going up, everybody's going to be wondering, well, what's wrong with this firm? They're meeting with a lot of other people. I don't want to be the first one to allocate to them. If your assets are going up, you know, I have found when we have been extremely successful raising money that asset raising is not linear, it is exponential. Success brings success. As you are calling on a lot of people, and as they see your asset, if your performance continues positively and you start increasing your AUM, they are much more likely to invest, and the more people that invest, the more people that invest. So what's the process to actually get the word out? So if you buy, hey, we got to build this brand, we got to penetrate the marketplace. The first thing you got to do is identify who you're going to call on. And I think you want to go outside the U.S. I think you want to do the U.S. I think there are a lot of inefficiencies outside of New York in smaller cities. A lot of less people go there. I think you want to go to Switzerland. I think you want to go to the UK. I think you want to go to Canada. I think you want to go some places over in Asia if you have the capability. Those are fantastic markets. There are tons of investors over there. When you start this process, it is a numbers game. The more investors the more meetings you're going to get, and the more meetings you're going to get, the more good prospects you're going to get, and the more good prospects you're going to get, the more you're going to sell. So the more people to call on, or the bigger your database, the better. And I've been doing this for 32 years, and I work even today extremely hard, along with my whole company, in identifying new investors. New investors appear all the time. And so we will, get conference lists, and we will look at these people, and we will do research on finding out who they are. And one interesting thing about conferences is you do have a lot of people that lie. They say they're investors, but they're not. So you got to figure out, who is an investor and who isn't an investor. We read trade journals to identify new family offices that developed, who's changed jobs. And probably, by far and away, the greatest tool to identify new investors is LinkedIn. If you're not using LinkedIn, you're making a big mistake. Most of the industry uses LinkedIn. It is an extremely powerful tool. And there's a lot of different things you can do with it. One is just researching people. Before you meet with someone, find out what their background is. And if it's a family office or if it's a fund to fund, you may not see their background because they either don't have a website or it's password protected. And in LinkedIn, you can see a lot of information. You can also see a lot of information about the whole organization, because when you pull up someone's contact information on LinkedIn and you click on the company, you can see everybody from the company who is in LinkedIn, and you can kind of get a rough idea of who does what at the company. LinkedIn also has a search function. So you can say, okay, I'm going to Kansas City, and I want to know, what family offices. So you put the word family office in the search function, Kansas City, and press go and see what comes up. Or hedge fund, or endowment, or foundation. Now listen, if you are identifying a new investor, you have to establish some type of relationship with them first before you can call on them. For Agecroft, it's easy. I can send them a presentation of our firm. I don't send any information on hedge funds. When I connect to them, it kind of documents our relationship has started. Another thing you can do is if you get an investor and you get their profile up, in the bottom right-hand corner, it will show other people viewed this person. And if it's a family office, the other people viewed these people are usually family offices. And then you can click on each of those, and you can just do this whole process all day long to build out, your network. Right now, I think we have, 2,000 contacts in Switzerland. I'm probably connected to close to 2,000 people in Switzerland on LinkedIn. And we have just spent huge amounts of time in Switzerland doing this, and now we go over to Switzerland and we can get, 30 meetings whenever we go, because we just have a broader list of people. So, obviously you want to go places where you can go frequently. It doesn't do any good to fly over to Geneva once. You got to go, every 1 quarter to every 6 months. When you meet with people, sales is a process. Everything's a process. Making sure your product is correct, making sure your marketing message is correct, and it's being consistently delivered, and also how do you approach the marketplace. And what you do is, when you meet with people, it's just very important that you, over time, hopefully you have a big pipeline of people that you've met. But you have to have a way of kind of quantifying how good of a prospect they are. At our firm, for every manager we represent, we have an Excel spreadsheet, and we have everybody we've done a meeting or conference call with, and we have this quantitative ranking on probability of coming in, and then we have a column that shows what is the next step. If you don't know what the next step is, they are not your prospect. And next step is hard. It's an art. It's how often you call on someone without pissing them off, or how often do you call on them without being a potted plant? Out of sight, out of mind. It's a delicate balance, and it's different for different people. And a lot of people will have a meeting with a hedge fund, and it'll go really good, and they'll be really excited when they leave. Like, that guy really understood what we do, and he really likes it. The problem is, 2 hours later, he's meeting with someone else. The next day, he's meeting with probably 3 other people. The next month, he's meeting with, 60 or 100 other people. And maybe right when you left the meeting, you might have been one of his favorite 10 hedge funds in the entire world. And it just kind of fades over time, which is why you have to have a process of following up and making sure you get back in to see him and knowing what the next step is. Some of the things I would encourage are a quarterly conference call. It's a very good way to get into, or for people to hear you on a regular basis. Having a conference strategy, it's a good way to get to see investors, and the more you see them, the better. I'm very fortunate because I represent a lot of managers, and I can see people very, very frequently, where if you only have one strategy, you can't do that. So conferences are a great way to get to see people more often. I'm going to come back to social media in a second, and I mentioned before that LinkedIn was a great tool to find prospects. You got to check with your compliance company, but there are a lot of people in this industry that have publicity programs, and that will talk about the hedge fund industry, will talk about the capital markets, will talk about anything but selling their fund. Again, money is going to firms with the strongest brand, and LinkedIn is an unbelievably powerful median to reach out to people. And it was probably 4 years ago, I shared something on LinkedIn, and I wasn't a big LinkedIn fan back then, and I just kept having people come up to me and saying they read it. And I'm like, you actually read that stuff? And they're like, yeah. So now, probably once a week, we will post something on LinkedIn relative to our firm, or if we're quoted an article or what have you. And just to tell you the power of LinkedIn, I did an article last week on New York State exiting hedge funds, and as of yesterday, I think 4,900 people read it on LinkedIn. And what does that mean? That means they actually had to click on the link and open up the article for it to count as a view. I did another article in January on hedge funds' top 10 trends in the industry. We had 10,000 views. Now, those are almost all people in the hedge fund industry. So, now granted, a lot of people know me, and I'm fortunate that people will follow and read what I say, but I think anyone can do that. When I write something, I want to get the biggest bang for the buck, so, we also have a publicity strategy. Now, granted, for Agecroft, it's a lot easier for me to get publicity than it is for a hedge fund. But, over time, I've developed very good relationships with the media. A lot of them are here, and I appreciate you guys coming. And, if you're on CNBC, or you're on Bloomberg Television, or you're in a number of these trade journals, it enhances your credibility. The final thing I'll say is we have a great video team here called Small Cap Nation. They do a cable television show. And I think video can be very effective. And the way it can be very effective is, again, the best model for us is traveling with a salesperson or traveling with a non-investment person at the firm and building out a big pipeline and only getting the portfolio manager involved further into the process. But if people want to see a portfolio manager, you can video the quarterly update of the portfolio and put it password protected on the website. And when you go and see investors, give them access to your website so they can actually see the portfolio manager speak. Or you could have the portfolio manager talk about his investment process and film him, and again, put it behind a password protected wall. I think if you do that, you want to do it high quality. I don't think you want, your kid to bring his video camera in and do it. Again, perception is everything. So with that, I think with the right focus, strategy, and determination, any of you can be the next Rocky of the hedge fund industry. And if you have the highest quality product, you have the highest quality message, and you have the highest quality sales strategy, you will be successful. I want to thank the sponsors. I want to thank all the speakers. We now have a break, and I really appreciate your time. Thank you very much.